So, have you ever wondered if there's just, I don't know, a quiet wealth management powerhouse out there? One that's just flying completely under the market's radar, even though it's consistently breaking its own performance records? We always see the flashy headlines for the usual megabanks, right? But honestly, sometimes the absolute most fascinating stories are hiding right in plain sight.
22%. That is Ameriprise Financial's massive year-over-year earnings per share growth for the second quarter of 2026. While a lot of their competitors are out there really struggling to find a sustainable riddle, Ameriprise is just quietly crushing it. And, well, that immediately begs the question, doesn't it? Why on earth isn't this stock priced like a high-growth market leader?
Welcome to our explainer. Today, we are peeling the onion on Ameriprise Financial, ticker symbol AMP. We're going to dive deep into their latest Q2 2026 earnings, unpack their valuation, and really try to figure out the market outlook for this company. Like, are they a true hidden gem, or is the broader market seeing a massive risk that we need to be paying attention to? Okay, so here's our roadmap for the explainer today. First, we'll hit the Q2 earnings surge, then move on to wealth management growth, followed by asset management dynamics. After that, we'll look at valuation and peer comparison, and finally wrap up with risks and forward outlook.
Number 1, the Q2 earnings surge, hitting the high notes.
Let's start by looking at the broad stroke headline numbers that honestly kind of shocked some analysts this quarter. $1.8 trillion. That is the record total assets under management and administration that Ameriprise just reported. That's a 14% year-over-year growth. To put that into perspective, client assets in just the advice and wealth management division alone swelled to $1.2 trillion. You definitely don't grow a base that massive by accident. That requires a highly tuned machine. And that massive asset base, it's translating directly into sheer profitability. Adjusted operating earnings actually climbed over the $1 billion mark for the quarter. That drove adjusted operating earnings per share to $11.07. So that's that 22% jump we were talking about earlier. But the real showstopper here, a return on equity of 55%. Management rightfully calls this distinguished in the industry. Basically, for every single dollar of equity, they are generating an incredibly high rate of return. It's wild. Section 2. Wealth Management Growth. The engine roars. So this wealth management segment, it is absolutely the undisputed primary driver of Ameriprise's recent surge. The really crucial takeaway here is the sheer efficiency they're extracting from their network. We're talking record advisor productivity, hitting $1.2 million per advisor. And how are they doing it? Technology. Actually integrating AI workflows is actively saving their advisors over 30 hours a week, which frees them up to, actually focus on client relationships. And on top of that, to offset some known asset outflows from the wind down of their Comerica relationship, they're strategically onboarding Huntington Bank in Q4. That move alone brings in 260 advisors and $28 billion in assets. That is a massive runway for growth. Which brings us to this incredibly candid quote from CEO Jim Cracchiolo. He was talking about the current state of recruiting in wealth management, and he noted that competitors are just making these crazy offers, cash paybacks stretching as long as 8 years. He said the promises out there with what's up front is probably different than the reality. Basically, Ameriprise is consciously choosing not to play that hyper-expensive game. Instead, they're competing on their tech platform, those AI tools we talked about, and their service. They're betting that long-term advisor productivity is a way better hook than some unsustainable upfront cash bonus. Section 3. Asset Management Dynamics. Squeezing the margins. Now, it's not perfectly smooth sailing absolutely everywhere. Over in asset management, the story gets a little more nuanced, so we need to take a closer look. During Q2, this segment actually experienced $6.5 billion in net outflows. Normally, right, that's a direct, painful hit to the bottom line. But look at the margins. The net pre-tax adjusted operating margin actually expanded. It went from 39% a year ago to a highly impressive 42.7%. How? Well, they achieved this by maintaining extreme expense discipline and benefiting from really strong performance in their Seligman technology strategies. So they are literally squeezing more profit out of a slightly shrinking immediate asset base. Talk about doing more with less. Section 4. Valuation and peer comparison. The pricing gap. All right, this circles us right back to our very first question. With 22% earnings growth, record AUM, and expanding margins, is this stock actually severely mispriced? Think about this. Ameriprise is trading at a trailing price-to-earnings ratio of just 11.8 times. Morgan Stanley, They're sitting at roughly 16.5 times. BlackRock is way up near 25 times. I mean, even the broader U.S. capital markets industry averages somewhere around 39 times. And according to analysis from Simply Wallsty, Ameriprise has a discounted cash flow fair value of over $1,100. Compare that to its current price, which is hovering around the low 500s, there is just a massive divergence here between their actual operational delivery and the open market multiple.
Section 5. Risks and Forward Outlook. The Skeptic's View.
So why the massive discount? We all know Wall Street rarely leaves a stock discounted without a reason, so we've got to address the bear case here. The core tension at the heart of this whole Ameriprise investment narrative is basically a tale of two trajectories. On one hand, you have the recent reality, an incredible 22.4% historical trailing EPS growth. But on the other hand, forward analyst estimates are predicting a much more modest 6.3% annual EPS growth going forward. The market is basically saying, hey, great quarter, but we really don't think you can keep this pace up. Skeptics believe this recent profitability might just be a cyclical peak rather than some sustainable new baseline. To really understand that skepticism, we have to look at three key risks. First off, those ongoing asset management outflows. You can't just rely on margin expansion forever if the underlying assets are trickling out the door, right? Second, that intense, crazy recruiting environment we mentioned, it means the cost of keeping and acquiring top-tier advisors is going up, which could definitely pressure margins eventually. And third, they're highly sensitive to macroeconomic shifts. If interest rates drop or the broader market turns, their fee revenues and cash sweep balances could take a direct, pretty heavy hit.
The verdict. Shareholder returns.
But look, regardless of whether you align with the bulls or the bears on this one, you have to look at what the company is actually doing with its cash right now. $932 million. That is the amount of capital Ameriprise returned directly to shareholders just in the second quarter, through dividends and share buybacks. To give you some context on that number, that represents a whopping 91% of their operating earnings for the quarter. They even reduced their outstanding common shares by 6% year over year. They are aggressively signaling to the market that they believe their own shares are heavily undervalued. Which leaves us with this final, kind of provocative thought. We've seen the record asset levels, the massive jump in productivity thanks to AI, the margin expansion despite outflows, and of course that massive capital return. But we've also seen the discounted valuation and those very cautious forward estimates from analysts. So I ask you, is Ameriprise Financial's past year of incredible profitability simply a high point in a cyclical market, or is it the establishment of a brand new, highly efficient baseline? It's a critical question, and honestly, how you answer it likely determines exactly how you view this stock going forward. Thanks so much for joining us on this explainer, and keep digging into the data.